Welcome back, Chart Addicts. We got a lot of requests from you guys to make a video about the recent article we put out about the Federal Reserve's dilemma. Hopefully by making this video, we can give you guys some context and answer a lot of the questions that you guys have been asking us. So I'll walk you guys through this article. It's pretty straightforward. I put up the main points at the top about why I believe the Federal Reserve has a dilemma on its hands. We talked briefly about the Federal Reserve's mandate, so price stability and maximum employment, and how that's shifted recently to focus more on inflation. I talked about the two biggest opposing viewpoints today, which is the Fed pivot crowd and then the tighter for longer crowd. So we'll kind of talk about what that means, as well as which argument kind of has a little bit more standing today. And then we're going to talk about some of the key data to watch over the next month or 2 months to be able to tell if the Federal Reserve is going to continue their tightening policy or whether they're going to end up pivoting on that policy and sending us back to the money printing era. So my main point for this article was that the Federal Reserve is in one of the most difficult periods of its history. The Fed has promised to continue raising interest rates and to continue tightening monetary policy until we've reached that 2% inflation target, or until they break something. Breaking something meaning they ruin something in the economy that sends us into a recession. Employment is one of those key metrics that the Fed uses to gauge the economic activity. So positive employment numbers have given the Fed confidence to continue tightening policy, despite the fact that the economy has slowed down significantly since the Federal Reserve has started tightening. If the Fed continues to tighten, it will eventually put a strain on the economy, and we're going to enter a deeper recession than we already are in. Recessions typically hurt employment, and they lead to a lot of loss of jobs. The Fed policy to fight inflation is a direct competition with their mandate to ensure full employment. And so if the Fed does not get inflation back to 2%, then their credibility is going to be at risk, and they cannot afford to have that happen. The Federal Reserve is very comfortable sending us into a prolonged recession in order to protect their credibility. And so because they've promised 2% inflation, which is very hard for us to achieve in this current environment, they will have to continue going tighter for longer in order to set us back to that normal path. And so we're kind of looking at a 2023 or 2024 recovery for the inflation problem and for the overall economy to recover. So let's briefly talk about what the Federal Reserve's purpose is and what their main mandates are. So they have two stated mandates. The first one is price stability, and the second is full employment. Price stability meaning that the price at the grocery stores and the price for consumer goods remains stable along with wages. And then full employment means that the majority of the working people in this country can find a job and are taking up the jobs that are available. Recently, the Federal Reserve has shifted their focus from these two mandates over to fighting inflation. Inflation is very dangerous because the majority of Americans cannot afford any extra expenses in a month. They're already living paycheck to paycheck. Inflation has caused an unnecessary amount of pressure on those families to be able to provide. Because inflation is still running rampant, despite the fact that the Federal Reserve is doing everything they can, it shows that the Federal Reserve is going to have to continue tightening monetary policy through next year in order to fight this inflation battle. Let's talk about the two opposing viewpoints here and the two biggest camps that are forming in the market. The first one believes that the Federal Reserve is going to pivot, which means they're going to change their mind about tightening monetary policy because obviously we go into a recession. They're expecting the Federal Reserve to start printing. And so the Fed pivot crowd are the folks that are expecting the Federal Reserve to start printing when we go into a deep recession. The second crowd believes that the inflation crisis is so serious and it is so bad that they're not going to start printing the money anytime soon. Money printing was a function of the last 10 to 15 years, and the tighter for longer crowd believes that the Federal Reserve is so committed to fighting inflation that they're not going to print money regardless of how bad the economic conditions get. The Fed pivot crowd are basically saying that as soon as weakening employment conditions comes in, so we start to see the unemployment numbers start to go higher and higher, and a lot less people have jobs, that's when the Fed is going to step in and begin to print money. So that's what the Fed pivot crowd believes. The tighter for longer crowd has a bit of a different perspective. What we mentioned at the beginning is that the Federal Reserve has promised that 2% inflation. And so in order for them to protect their credibility, they have to maintain that 2% inflation target. By doing so, they're going to have to tighten the monetary policy to restrict monetary activity, to reduce the amount of money in the system way longer than a lot of people expect. Following the 2020 crash, the markets recovered in a span of 2 months. And what that showed was that when the Federal Reserve is willing to print money, the markets can recover in a very quick manner. Because the inflation crisis has gotten so bad, money printing is no longer on the table. And so we can be expecting a much longer recession than we typically see in financial markets. What I said in the article is that there's evidence to support both cases. The Fed themselves have reiterated that the tighter for longer playbook is the one that they're going to stick with. They don't care about financial markets, is what the Federal Reserve keeps stating. They don't care if the markets crash. Their number one priority is to create stability in the inflation fight. The pivot crowd believes that at the first sign of trouble, which means that employment takes a hit, the Fed's going to reverse its course. Those are kind of the two biggest perspectives. But in our opinion, we believe that the Federal Reserve is going to go tighter for longer in order to save their credibility. What are the most important data points to watch in order to gauge if we're getting closer or further away from a Fed pivot? Well, here's the top four that we've noticed. Number one is unemployment. Number two is the inflation prints, being CPI and PCE, the two core measures of consumer inflation. Sentiment and sales. And so corporate sales and consumer sentiment is very important, because as long as people keep spending, economic activity continues. When people are no longer willing to spend, that's when prices are going to come down. That's when economic activity slows down, and we're going to see a recession. And last but not least is GDP, which is the overall productivity or the overall growth of the economy. Are we growing or shrinking? And so if employment continues to be healthy, the Fed is going to stay the course. If inflation continues to be high, the Fed is going to stay the course of tight monetary policy. If sentiment starts to slow down and we go into a recession, this is what might cause the Federal Reserve to take their foot off the gas of this tightening policy and to maybe start exploring quantitative easing. And GDP, of course, as long as GDP is doing well and as long as the economy is expanding, the Federal Reserve is not going to see it as a problem to continue tightening monetary policy. So we would need, whenever we say the Federal Reserve is going to continue to tighten until they break something, one of these four metrics could break, and that could lead to a Fed pivot. And so if the unemployment numbers get way too high, that could lead to a Fed pivot. If the inflation numbers remain high despite a lot of their aggressive action, they will have to become more aggressive. If sales and sentiment start to drop dramatically, then we're going to go into a bit of a recessionary period. If the quarter closes and we get another print of negative GDP growth, this is going to be very, very shaky for the economy, and the Fed may decide to pivot to save us from an even deeper recession. So to kind of sum all this up, the Federal Reserve has a huge dilemma on their hands. They promised 2% inflation, and we're a long way away from that. So most likely we're going to be headed into a tight monetary policy in 2023, and this could last potentially the entire year until we reach that 2% inflation number. Now, in all reality, the Federal Reserve themselves have indicated that they're expecting anywhere between a 4 to 5% inflation number in 2023. Meaning if they're expected to reach their target of 2% inflation, it won't be next year. We're going to have tighter monetary policy for much longer. And then 2024 or 2025 is when we may see a shift in monetary policy and a recovery of financial markets. So that's the timeline that we're operating under. Highly recommend that you guys come through and check out the entire article, chartaddictsfx.com. You can head over to the free resources tab and head over to analysis to check out the article. There's going to be plenty of articles written in the next few weeks. So if you're interested in the Russian oil crisis or what's happening in Japan with their currency, keep an eye out for articles and videos coming very soon. Ladies and gentlemen, Chart Addicts signing out. Peace.